Assalamu alaikum wa rahmatullahi wa barakatuh. Hello and welcome everyone. Thank you for joining us today for this webinar, Navigating the Effectiveness of Interest Rate Cheapeners. To introduce myself, I am Muad Al-Husseini from Ihata Financial, and today we are delighted to walk you through a financial risk management journey around interest rate market development and the hedging aspects. I have with me Mr. Aditya Bijal from Ihata Financial, who will address different aspects alongside me as we progress with the presentation. This webinar is being recorded. We aim to wrap up the presentation within 1 hour, including the Q&A session. We will make sure to share the recording with you post the webinar. During the presentation, you may type any question in the question box on your screen, and we will be glad to answer them at the end. We will also ask 2 poll questions during the webinar, which you can easily respond to by clicking the most relevant answer from the multiple choices presented to you. So we can now kick off the presentation. The discussion today will be around a market backdrop and development of what's happening on the interest rate. This is the hot topics these days around the acceleration of the interest rate locally and globally on the LIBOR and other indices, and locally on the SIBOR, which has recorded repeatedly new highs these days. We will move after that to talk about the uses of the financial derivatives and the importance of KPIs and the risk measurements and the assessment that has to be kept in place for any entity that wishes to hedge its exposure. Then we will walk you through a brief of hedging instruments. And of course, we can't leave the interest rate cheapeners aside. We will talk about the usage and the local trend also in the interest rate cheapeners and the various important risk management aspects, considerations when trying to utilize them for hedging. Then we will have a certain consideration to conclude the presentation. At the end, we will be very much glad to address your questions around what has been said in the presentation and any other relevant topics. Just to introduce ourselves, Ihata Financial, we are authorized and regulated by the CMA. Our focus is on the financial risk management, hedging, and the market risk management. We are proud to be the first specialized local advisory house, independent, to address these kind of market need and around the hedging, around the different asset classes, FX, interest rate, and commodities as well. We have dealt with top-tier institutions, government entities, non-government entities, public institutions, and we bring with us half of a decade experience in this company. And also the consultants and the directors who are working with the firm have plenty of banking and non-banking financial experience. It's very much important to highlight that our independence here means that our advice has nothing to do with executing transactions. We are not selling any derivative transactions, and we don't benefit from the movement of the instruments that we are advised on. As we said, our coverage goes to interest rate, commodities, foreign exchange. We do valuations, of course. We do IFRS 9 hedge accounting to account for the hedges in your books. We of course do dispute resolution to address any concern of any potential mis-selling of any derivatives. We go deep and we partner with the client to exactly pinpoint the issues and the dispute resolution, and we try to have the most beneficial outcome for our client. We also do a number of restructuring advisory as well for the existing hedges if they are not moving as intended. So perhaps we can kick off the discussion with a bit of a market update. If we look at the big picture, we understand that the Federal Reserve in US has a dual mandate and always had. The aspiration for them is to achieve maximum employment and maintain price stability. However, these days, as you can see, that the inflation is recording a new high every month. We have reached a peak inflation of the last 40 years. It was 3 months ago at 9.1%. The deceleration happens indeed, and we are at 8.3% as per the last reading. There is another reading next Thursday. However, these levels remain elevated and at the higher side. Hence, the focus of the Fed is not really on the employment. In fact, they want the employment to deaccelerate. They want the unemployment to be a bit higher than what are we currently having, in order to tame the inflation and fight the price instability that is existing right now. More than once, the Federal Reserve has affirmed their stance when it comes to fighting the inflation and staying on course. We can see that the market was hoping for a kind of pivot. This is the word where it was extremely popular the previous few days in terms of Fed pivoting or coming back and saying and deaccelerating the expectation of the interest rate hike pace that we are and the momentum that we are witnessing right now. We have seen different central bankers around the world are having difficulties in managing liquidity and managing the bond markets, like what we have seen in the Bank of England last week, and also today with their intervention in the gilt market and the expansion of their operation to stabilize the market. It's this kind of situation is not yet there in the US. However, when we talk about the time lag between having this kind of acceleration in interest rate and the exact impact, this is where the magical formula will work out, and it's not fixed. So we might face the consequences of kind of acceleration in the interest rate, perhaps not this month, perhaps Q1 2023, perhaps later. However, the Fed has voiced its concern that inflation is not transitory anymore, at least, and they have been communicating this for a couple of months, that they are on course to fight the inflation going forward. And when we move and we look exactly how does this inflation look like in Saudi here, we are currently, as per August, we have reached 3%. It is accelerating, not as much as the US. Perhaps what's helping the local market here is, for example, the cap on the energy prices that we have right now. It's helping the case. If you can see the attribution of the CPI in Saudi, you can see that the transport, food and beverage constitute a significant portion of that CPI basket in terms of changes. Of course, when the Fed hikes the rate, we hike the rate. As you know, last time we hiked 75 basis points in tandem with the Fed, and this will have an effect of deacceleration in the economic activity. It will mean higher financial costs for a lot of corporations as well. So it will also have a certain contribution to manage the inflation going forward. Maybe these things are happening around, and while the oil price right now hovering around $95 and $100, which is really helping the government budget to fight the consequences of such an eventuality. We have heard many instances where the government aiming to build the previous depleted resources into more strategic reserves in order to fight and stay up against such economic hardship if it happens going forward. If we be more specific now around the cyber, and perhaps this is the talk of the hour, where the cyber at currently, what you see, everyone here, the curve of the 3-month cyber currently, and the expectation till October 2026, or for the coming 5 years. So what do we have here? Currently, the 3-month SIBOR stands at around 4.4%, as you can see from the solid blue line here. And the expectation, as per the market consensus right now, and as per the Fed also expectation, is that the 3-month SIBOR, which currently stands at 4.4 or 4.5%, will touch 5.5% as soon as October next year or April next year, as can be seen in the forward curve. This forward curve means an expectation of the market around where SIBOR could go. However, these expectations are inferred from the current environment, meaning that the same forward curve 1 year ago was this one below, the dotted blue line, where the expectation of 3-month SIBOR 1 year ago was to be 1.25% only by October 2022. Well, we are close to 4.5% right now, which shows that what happens in the market, in the acceleration, in the change of the inflation narrative by the Fed has contributed for that curve. And if anybody wants to hedge their exposure, they're afraid from the SIBOR going higher and higher, they can do that at 4.94%, hedging 3 years at 4.94%. However, hedging 5 years is a bit cheaper, 4.78%, which goes against the economic intuition, because if you hedge for longer duration, you should pay more. However, because we are living in an environment where recession is expected, we can see that the close-end rate here, the closer rate, the short-term rates are expected to be higher on average than the long-term rates. Hence, if you want to hedge 3 years, the expectation is for the Fed to keep the prices higher for longer. Now, we want to move to an extremely important topic as well: the use of financial derivative. When we see the derivative market size, the over the counter and the exchange traded, we can see that out of the $687 trillion globally by end of 2021, around 88%, almost 90%, is being driven by the OTC market, which is a bilateral agreement that are not cleared between the different users of derivatives, and 12% are being exchange traded, similar to the one in the Tadawul. For example, the index futures and the single stock futures that Tadawul has launched in Saudi, they qualify to be under the exchange traded. However, all the derivative instruments, the other derivative instrument, interest rates, for example, that the local banks are selling, they do fall under the over-the-counter market. So inside that over-the-counter market, looking deeper, we will find that the majority or the major contributor of this is the interest rate product, then the foreign exchange, then a small percentage is being contributed by the commodities, equities, and also credit linked. So this is what is moving the market. We can see the trend from the second half of 2019 till first half of 2021, as per the Bank of International Settlement data. However, not to misguide anyone, if you look at the valuation of these derivatives, you will find a totally different picture. Why the interest rate has a much bigger notional than the FX? Because interest rate uses a notional, whereas the FX is not using the same methodology. FX means actual transaction. However, the notional and the interest rate are reference transactions. So maybe to have a fair comparison, the valuation will give a better story. However, it shows, the moral of this shows that how big is the over-the-counter market. Now, the market participant here, and this has been a very big topic here locally, am I hedging my exposure or am I speculating on my exposure? And really, some people would be under the assumptions or under the thinking that their exposure is being done for hedging purposes. However, when market moves in a very unexpected way, when the market goes volatile, this is where exactly the most you need the hedging. So people realize that they have not done the right hedging after this kind of market volatility. So in order to really distinguish, are we hedging or speculating, we go into our objective. Are we maintaining our risk exposure within the risk appetite? Do we have a risk appetite that for example, that our cost of funding should not exceed 5%? In order to do that, we go ahead and we execute an interest rate swap, or we execute a cap, or we execute a financial derivative that has no chance of making us paying more if market moves against our favor. So doing the hedge means that you have a low to moderate risk appetite, and there are no return targets. You're not speculating, or you're not hoping to do that. And the speculation, we are not here saying that it's wrong to speculate. However, it's very much important to identify your objective. If the objective is to invest, for example, a certain capital has been allocated to investment, then it's fine as long as you define what you want to do with this kind of market-driven expectation. So the idea of speculation, you want to take advantage of price volatility and leverage in increasing the potential profits. This means that the risk appetite is a bit high and the return targets are high. So it's very much important to distinguish between hedging and speculation. Now, before we move to the importance of the KPI selection or KPI protection, we have a poll question now. It's an important one to set the stage of this presentation going forward. I will publish the poll question right now, and I will read it as well. Okay, as you can see, the question is, do you have any financial derivatives to hedge your exposure to interest rate? So the first choice is yes, and we are happy with current practices. Yes, but the outcome is not working as expected. No, but we need to consider hedging our exposure, or no, and we don't need hedging. So you can answer these questions. We will have 20 seconds chance for you to answer, then we will publish the answers. Okay, we will close the poll in 5 seconds. Okay. So we will share the results now with you. Okay, now we have nearly 50% have answered that yes, and we are happy with the current practices. Perhaps this is being felt with the current market movement, and their rate business and their rate instruments are working as intended. We can see that 20 and 20 is separated between yes, but the outcome is not working as expected, or no, but we need to consider hedging our exposure, and the minority says no, and we don't need any hedging. So Aditya here also with us. Aditya, if you have any comment on this, on the answer, on the results of the first poll.
Thank you, Muad. Looking at the results, think it's in line with what we see out there in the market as well. So a majority, it looks like they have instruments that are in line with their risk appetite, but we still see 1 in 5 scenario where the outcome is not working as expected. So this is the area we need to really focus on to understand these uh, why these are out of line with the risk appetite as set out.
Thank you very much, Tia. Let me stop sharing now. Okay. Now, let's move to something really crucial for any company. Now, in order to select the KPI, the question always has been the question is that, what am I protecting? What am I hedging? What is the trigger for me to hedge? Is it to protect a certain income? Is it to protect a certain financial ratios? So it is really, really important to have a certain trigger or a certain KPI to protect. So the three building block of the selection approach to that KPI is being relevant, material, and accessible as well. Being relevant, meaning that the hedging action that we make will have a direct impact on the KPI. For example, if you are hedging, of course, it will have a direct impact on your profitability. It will have a direct impact on your financial ratios. We'll be having visibility on the interest rate cost. So pick the relevant, but also a material KPI. So you have to pick a material KPI that is accessible, that is very easy to calculate, straightforward, picked up independently. For example, if a certain company has zero debt, okay, or has a small debt, the leverage ratio is relevant. The hedge action will impact it, but is it material? No, it won't be material at that stage, because the debt almost does not exist. But when we talk about the debt, when we talk about the IRR for profitability, when we talk about the budget visibility on a certain aspect or certain elements on the financials or on the operation. So these kind of KPIs become relevant and material as well, and can be easily calculated. So if you got the KPI right, it will really help that the hedge is working as intended, and vice versa. Now we want to give you a brief on hedging instrument. Perhaps being a financial risk here, financial risk consultants, when considering hedging your portfolio, we always prefer to look at a plain vanilla instrument. Plain vanilla instrument means the easy instrument, the accessible instrument, the instrument that does not have opaque pricing or complex building blocks. So it is very much basic and understandable structure, and most importantly, it serves the hedging objective. So a simple example here, and this is I would say, the most popular interest rate swap, or the most popular instrument that we have is the interest rate swap that you see now. When any borrower or any client enters into a transaction with the bank, a lending transaction, it will have only the right hand segment, where the borrower will always pay the low margin and the SAIBOR, be it, for example, SAIBOR plus 3%. So the 3% is the credit margin, the loan margin, but the SAIBOR, which was sub 1%, below 1% only a year back, now at above 5% or around 5%, this SAIBOR can be managed or can be hedged via entering into hedges. So here where the interest rate swap works, so the hedging bank, which can be also a lender, okay, though the local banks are being to sell these products, interest rate swap, you will basically enter into a fixed rate interest rate swap, where you pay fixed as an institution and you receive the SAIBOR. So whatever SAIBOR you receive as per the schedule of the loan, you will be passing it to the bank. So this SAIBOR will cancel this SAIBOR, and you will end up having a fixed loan margin. So you have a loan margin of 3%, and you have a fixed rate of 3 or 4%. It depends on the market rate. The fixed rate 1 year ago, 1.5 years ago, was around 2% to do that. However, today is close to 5% for 3 or 5 years, as we saw in the market backdrop slide. What are the pros and cons for this? They are very much easy. The idea here as a positive is that there is no upfront cost. So you are not paying anything to get into this transaction. And of course, you are exchanging a floating interest rate for a fixed interest rate, thus covering your exposure. And hedge accounting can be applied to the entire mark-to-market. This is really important. The IFRS 9 consideration, or the hedge accounting, or the accounting consideration, is vital for any institutions. You don't want to get into a financial instrument where it disturbs your financials if it's not a hedging instrument. Hence, if you can successfully prove that the hedging instrument is really hedging the hedged item, there is an economic relationship between both, then you are entitled to apply hedge accounting, where the impact of the valuation of this instrument will go into your OCI. It will not hit your P&L, and this is voluntarily. You can apply IFRS 9 hedge accounting, and you cannot apply it. It's up to you. However, as a financial risk management approach, it is advisable for you to consider this. It will ensure alignment of interest or financial risk management objective of the hedging instrument and the hedged item. What is the disadvantages of the interest rate swap? Credit line is required. Because this instrument can go negative or positive, the bank needs a credit line. It's exactly like a bank needs a credit line for lending you money. Of course, they need a credit line to offer you this. And there will be an extra cost burden in a declining interest rate environment, meaning if you fix the rate today at 4%, okay, and something happened, the Fed pivoted, or the interest rate for any reason came lower, you at the time you would have wished that you have not entered into any kind of rate fixing exercise. You in this case, it is not in your advantage to fix at 4%. In this case, you can really enjoy the market as it goes lower. And of course, the third thing is it can become a liability and lead to a breakage cost. In the case where interest rates go lower, you would want maybe to break this IRS, or in case that you have prepaid your loan. So there is no need to hedge any loan. The loan does not exist. Then you have to independently go ahead and cancel the structure. The structure can be positive or negative. It depends on the market. But if the market goes lower, then it means really a negative for you, and you have to pay the breakage cost. When we look at the interest rate cap, it's another very interesting and plain vanilla simple instrument. In the case that you want to participate in the market, so in the case where SAIBOR go lower, interest rates go lower, you will not be obligated to fix yourself at a higher rate. But as they say, there is no free lunch. Cap means you have to pay a premium to the bank in order to enjoy this benefit. So if you pay a premium here, you get the cap, you will only receive the compensation if SAIBOR moves above the strike. If you fix at 4% and SAIBOR at 5%, the hedging bank will pay you the 1%. But what happens if market at 1 or 2% has dropped significantly? Then you are not obligated to do anything. You will enjoy the market, and it will give you the flexibility, as says here, to benefit from the low floating rates should they be lower than the cap strike. So it really gives you a pre-agreed maximum rate of interest, and the cap will always be a positive for you, meaning it's always an asset because you are paying a premium for it. So there is no way for it to be a liability. And in this case, if the liquidity permits, especially in an environment where the rates are extremely high, then it might be advisable for you to go for a cap structure as opposed to an interest rate structure. Okay, let's move. Maybe one thing to highlight here, everyone. I understand that we will be waiting for the Q&A session at the end, but if you have any questions from now, please feel free to just write any questions, and we will take them one by one. If you want to have a higher chances of your question being addressed or answered. Thank you. Okay, now let's get some flavor of where the pricing at for the interest rate swap and the interest rate cap, the thing that we have just explained. Hedging your exposure, hedging your cyber exposure for 5 years, if we assume that you have a 300 million riyal of notional, 300 million riyal of loan bullet payment that you want to hedge it for 5 years, it will simply cost you around 4.83% as of 7th of October 2022. Of course, 7th of October 2021, the rate was extremely cheaper than this rate. However, the rate now is higher because the hikes, because of the higher interest rate expectations going forward. This is what you buy. You buy the future expected interest rate increases as per the implied forward rate. If you have a 300 million riyals of a loan and you want to hedge it, this means every basis points in the hedge means a 134,000 riyal. So if the market price at 4.83 and you have concluded at 4.9, this means there was 7 basis points added. They were added above the 4.83, and the margin is 134,000 riyals multiplied by 7. This is how the hedge providers make their money, by getting some sort of spread over the swap strike rate. And if we move, this is very straightforward here, the swap. But if we move to the cap pricing, you basically can fix at 4.83, but you want to really enjoy the market if it goes lower. And this is very simply done by paying almost 10 million riyal to protect the 300 million riyal. So you pay 10 million riyal, and no matter what happens above 4.83%, you will be protected in an unlimited way. And if you feel that 10 million riyal is a bit expensive for you, you can protect yourself at a higher interest rate at 5.25. If you protect yourself at 5.25, this means that you have more room to be penalized from the market movement. However, you have reduced your all-in premium in Saudi Riyal. These premiums can be paid in amortized basis. It depends on the agreement between you and between the bank. And this is the OTC. The OTC products are very much tailored, customized according to your need, according to your loans, according to your financial risk management aspirations. Okay, what we will do now, we will be moving to talk about interest rate cheapeners, and perhaps this is the trend right now. People are finding current plain vanilla instrument a bit expensive, so that they are looking for how can they have the optimal cost structure for their hedges, which is fine to do that. However, there are extremely sensitive topics and considerations that have to be taken in order to make an informed decision making on which interest rate cheapeners as an instrument is appropriate for us and which are not. And before we move into expanding on this topic, I would like to share with you the last and second poll, which I hope you can answer and address in this webinar. Okay, as you can see, for those with interest rate derivatives, what instruments are in place now? So assuming that you have an interest rate derivatives, you will be addressing this question. Do your instrument are your instruments simple and plain vanilla instrument like the one we have explained, interest rate swap and interest rate caps, or your hedging instruments are structured instrument like range accruals, inverse floaters, callable transactions? So it's very much important to address this question in order for us to adjust the tone accordingly in the slides to come. I'll give you 20 seconds to do that. Thank you very much. Okay, let's end the poll. And I'll share the results. So almost 80% have answered that their instruments are simple and plain vanilla. And we have around a quarter of those respondents have said that we're having structured instruments like range accrual, inverse floater, or callers, or callable transactions. So in this case, I guess the next slide for them will be very much relevant. Aditya, if you want to add anything on this, please.
Sure. Thank you, Mohan. Again, we see that the structured instruments, the amount of people who've answered that is very much in line with the first poll. So I feel that with the higher interest rates, some of these instruments might have started giving unfavorable results. So I guess this is also quite in line with what we would expect.
Excellent. Thank you very much, Aditya.
Thank you.
So here, perhaps we highlight the suitability of these instrument, and it's really important to choose the right instrument. And with a bit of exercise, with a bit of due diligence, you can really understand whether these instruments are appropriate or not. The reason we made sure to bring this topic is because of what we have observed locally during the last few years, and perhaps even now when interest rates have actually picked up in an unexpected manner. We witnessed that few firms were engaging into complex interest rate and also FX derivative transaction without a clear perspective or idea on the potential implication of carrying such risk. We have no issues if the risks are clear and the objectives are agreed. However, some firms could utilize derivative with the aim of achieving short-term gains and supporting operational or financial hurdles. Some others were forced to actually do that because they are restructuring an existing hedges, and it really becomes an even more crucial exercise if you are restructuring an existing hedge. Sometimes the existing or the restructure itself will be perceived as a band-aid for a problem that happened in the past, and that band-aid will turn into a snowball as the market continues the unexpected movement going forward. So here we are putting some examples of these instruments. For example, swap with knockout, interest rate collars, range accrual swaps, cap spreads, all these names and can be actually called for these cheapeners, but some of the cheapeners, if they are well understood, might be the optimal solution for the client. For example, an interest rate collar means that we have a combination of a cap and floor. We all know the cap. We have seen the cap. The cap actually sets a maximum cost on a company. So this is the interest rate. If the interest rate goes higher and exceeds 4%, i.e. the cap or the strike, if the strike is 4%, if you have fixed yourself at 4%, you will be fully compensated of what goes above 4%. Okay. However, because this cap is expensive, we have seen it cost millions, you can at the same time sell a floor where, yes, you can enjoy the market if market goes lower. However, if the market goes below the lower strike, the floor that you have sold, then you will be paying the difference between the market and the lower strike. Here you can say that I'm okay with paying 3% if I reduce the cap premium today by 3 or 4 million riyal. So as long as the objective is there, then you have no issues. However, for transactions like, for example, a callable swap, or they call it cancelable swap, the idea is a bit different. And let me expand on this a little bit. We remember that the all-in swap strike, we have seen it at 4.83, and some companies will look at it as an extremely expensive to fix their hedge at 4.83. So what they can do, or what the bank might offer, they said, okay, I want to give you a cancelable swap or a callable swap. So the client will have a chance, or the company will have the chance of reducing that number by almost 100 basis points. So instead of 4.83, you will be having 3.86 million. So if you multiply the 97 basis points by the movement of each one basis point, that number is around 13 million riyal. This might look very much lucrative for these clients. However, this means eventually, if market moves higher and higher and higher, this means that the bank has the right, or the institution who sold the derivative, they have the right to call the derivative, to cancel the structure in a situation where you mostly needed this kind of protection. This is why this is very difficult situation for some clients, and we cannot call this transaction a hedging instrument. Why? Because they don't move in tandem 100% with the loans. The loan will continue. You will be paying a higher interest rate. At the same time, it will be expensive for you to borrow at the market, because you don't have any hedge anymore. Moving to the interest rate collar, what we have seen in the previous slide is that let me see something. Is that the cap that you bought and the floor that you have sold here means that you have paid a premium and you have received the premium to reduce or eliminate the premium, the net premium that you want to pay. In this case, we have a cap strike. If we assume it's 5.5% today, the cost for it is around 7.7 million. Okay, and if you want to cover the whole cost, you have to accept that you will not enjoy the market below 4.4%. So if market goes really below 4.4%, you will be fixed at 4.4%. So you have this kind of at the market situation between 4.4% to 5.5%. Above 5.5%, you are unlimitedly protected. Below 4.4%, you are fixed at 4.4%. This means the premium is nil. Sometimes you don't want to have this kind of entirely offsetting the premium. You can have the floor strike at 3% or 2.5%, but this means an upfront premium should be actually adjusted to cater for that, and you will be paying a net premium. Now, before moving toward the key takeaways here, the plain vanilla instrument has what we call a symmetric payoff, whereas the complex derivative structure is asymmetric, meaning that the complex derivative structure might be limiting the upside potential and has an unlimited losses or open-ended risks. And this is really important. For example, let's give an example. This is a Monte Carlo simulation that we have done internally, and it shows how the plain vanilla derivative, for example, would move. For example, if we assume this is an interest rate swap, a plain vanilla interest rate swap, it will start from slightly negative because of the profit or the charges the bank is charging. Then the eventuality of the mark-to-market, how the fair valuation of this derivative, it could go higher, it could go lower, but as you can see, you have equal chances of this being done. However, in a complex derivative transaction, for example, callable structures, you have a certain advantage that is really capped at a certain level, but the losses are unlimited. And this kind of risk demonstration is enough for many entities, for many clients to decide not to engage into complex derivatives with opaque pricing if this kind of demonstration is there. And this is what we are trying to achieve with these clients, just to make them aware of what they are embarking on, what journey exactly in terms of potential mark-to-market evolution. The structure might look very much tempting at the start. However, moving forward, the market can make it extremely challenging for any client. So the complexity of these trades makes it difficult for the user to estimate the true carried risk, and also make the visibility of their pricing really vague. So again, the problem gets more complicated when restructuring an exotic hedge or complex hedge portfolio with another exotic hedge. So to conclude our presentation, and thank you very much for each one of you who participated and joined us today. It is really crucial to set the risk appetite and the risk management objectives before doing anything. Check the KPIs, and we understand the current maturity of the company in terms of the financial risk management, the risk that the company is actually experiencing, quantify these risks, try to measure them, try to report them, and seek the best and optimal structure that is best suited to counter or mitigate or eliminate this kind of risk. So in any transaction that you are entering into, it's really vital to understand the building blocks of your hedging instrument. What are the risks inside that instrument? Is it a plain vanilla? And if it's not, what are the building blocks? Is there a callability feature? Is there a leverage embedded in these structures? So this kind of questions is important to have it with the bank that's selling the derivative, or also internally to get an idea. If the transaction gets even more complex, so it might be also advisable for you to seek an independent perspective. Measure the potential consequences of entering into the derivative structure. Are you targeting the economic benefits or the accounting? So it's really important. Some corporations, they prioritize the accounting implication over the economic implication. Some others are not looking at the accounting implication as much, that they feel the economic impact is worth of actually paying attention to. Then at the end, we qualify the instrument as it is aligned with the risk appetite and the strategic objective. The minute the transaction is executed, the journey will start. The journey did not end there. Monitoring the underlying exposure, how the market has moved, and how the market has changed, and also looking at the exposure itself. Are you expecting to prepaying the loan so the hedge will be more than what you need? So it's very good to plan. At the same time, on the other hand, you look at it, if you want to actually borrow and you have an expectation that you will borrow in 2 months or 3 months or 6 months and you don't have any hedge, so it is possible for you to pre-hedge your exposure. You can enter into a hedge now for the expected loan that you will be striking in couple of months or in the future, if you have a high likelihood or probability that this kind of loan will be taken. So they are the key takeaways that we want to share with you. And perhaps I don't know, Aditya might add something before we move to the Q&A session as a closing remark. Aditya, please go ahead.
Yeah, just to summarize the presentation in a few lines, I think the choice of which derivative to go for should be more in line with the company's objectives and less from more in line with the company's objectives, and to understand all the risks associated with going in for any structured product, and the analysis to be done whether that product is really suitable and in line with the objectives, or is it something that could lead to more problems in the future than the solutions it provides.
Excellent. Thank you very much, Aditya. Okay, now I guess we can move to the Q&A session. So thank you everyone for your participation. If you have any question, you can type it in the question box, and we will look at it and answer accordingly. Now, the first question we have is, we have fixed rate interest rate swap with hedge bank of our borrowing bank. We took hedge at 95% of borrowings. Now we see swap rate is very high, hence I'm losing for the hedge remaining 5% of borrowing as well to reduce the exposure. Do you have any product? Okay, first of all, we don't sell any product. We advise a client on purchasing or advise the client on engaging to the optimal product. This is just to be very much clear. Yes, at least you have hedged now 95%. I understand for these kind of projects, you might have a very tight IRR aspirations or the or KPI that you want to protect, and the 5% remaining is creating a bit of noise. So how can you go around this? Again, it really goes back to the KPIs that you have and how different instrument will react to that. I.e., meaning, if you want to consider an interest rate swap to hedge the 5%, according to the financial model and according to the stress testing on the interest rate going forward, how would the interest rate environment impact your IRR? So in a situation where your hedge is kept open and no further hedging in place, so the 5% is open, you have to really do a stress testing on that and understand how much you could stomach as a further increases, and what is your risk appetite and the risk capacity. If the risk capacity is extremely limited and you cannot go further beyond a certain level, then it is very much advisable to use an instrument, to use a derivative where it fixes your interest rate. But if you have a certain flexibility to pay a premium while you want to really take advantage if market goes a bit lower, because you have already fixed 95%, then maybe a cap is advisable. What I can say for sure that for this kind of project, executing an interest rate cheapeners might not be the optimal solution. Okay, let's move to the other questions. We have a question here: with the current growth and the huge giga project in KSA, how the government is going to overcome the increase in interest cost and the coming hikes to achieve the target of financing of these projects and maintaining the cost of these projects. Based on that, is the government of KSA going to have some cyber interference in year 2023? As I said, our monetary policy is really linked to that of the US, just to defend the peg. The government has been very much vocal into building the depleted resources or reserve that has been in the past, just to strengthen the fiscal situation and the stance of Saudi overall. So the question that I can see here very much relevant is how these giga projects will work. Now we understand that many PPP transaction, when it comes to actually submitting the bid and winning the bid from the procurement authority or the procurement company, that period of kind of interest rate risk is being passed to the procurer and not to the bidder. And this explains why most of these transactions or most of these projects are being fixed almost at 100% fixed ratio, just to avoid any disruption in the project itself from similar moves like we are witnessing right now. Now, what happens, and this is the question is around, what happens currently for the new projects? Well, the market has increased to 4 and 5%, and the bid package and the costing and the budgeting should take this into account, because now you have a different interest rate environment, and the cost structure will of course account for that.
Yes, if I can just add to this, most of the time, like you said, the interest rates are embedded into the bid itself, but also the actual relation is between the bidder, or if once it wins the bid, the project company, and the financial institutions. And given the nature of these projects, most of them, the company's policies outline how much to hedge throughout the tenure of the project. So in these cases, the hedge ratio is defined not by the availability of any structured derivatives or vanilla derivatives, but through the internal policies of the bidder and the project company, which takes care of which products are permissible, how much should be hedged, and what the underlying rate is.
Thank you very much, Aditya. We have a question here. How do we deal with outstanding derivative structure that are no longer achieving the intended objective? Thank you. Excellent question. We have seen that some of the respondents, they indeed have a derivative instrument, but it's not working as intended. My first advice is that to reconsider the situation, or reconsider the position if any restructuring advice or restructuring offer is being received. So before you go into any restructuring solution, before you do anything, you have to really understand the risk from the current structure before you do anything. And it's really important to link it with your KPI. Some companies will be a bit desperate not to lose in the short term, and they have this kind of ambiguous picture on what they have, what they should do. So it is very much advisable to look at the situation, to understand where the mark-to-market is, the valuation of this instrument, and how the restructured solution will achieve my financial risk management aspirations. When I say financial risk management, it might be just fixing the mark-to-market and paying the cost of it, because this hedge turns to be a speculative one and it is not serving the intended objective. So it is very, very important to consider or reconsider the position before entering into any restructuring solution. Okay, we have a question here. Is the record available? Because yeah, of course, we will share the recording, and we will share the presentation as well. It's 11 a.m. I'm afraid that the time is up for the webinar. For more resources, you can check our website ihata.com.sa. If you like to follow up on any question, or in case that there are any unanswered questions, please do get in touch, and we will be glad to get back to you as soon as possible. You will find the recording, as I said, hopefully. And again, thank you very much for joining us, and we look forward to conducting similar webinar going forward. Thank you and goodbye.
Thank you, everyone.